So let's just level set. I'm going to invite on stage now members of our first power panel. So we have Nik Chillar from ACTIV CRE Capital Strategies, Jackie Kuiper from Nelson Kuiper. Unfortunately, Hunter Watts was struck down with the dreaded COVID, and so we decided it's probably best not for Hunter to attend, but we wish him all the best. And Michael Richards from JTC. So. Okay, you just flick that up there just to share the mic amongst you there. Great. Just bear with me 1 second. Okay, so just to start with, first of all, thanks very much for joining us at Signals. It's a real pleasure. I've had the opportunity of working with everyone on the panel here in various capacities over the course of my career, and have a tremendous amount of respect for their knowledge and the insights that I know they're going to bring to the panel today. So if I can just ask each of you to quickly introduce yourself and your company and your area of focus, and then we'll dive into the topics of today. So, Nik.
Sure. Nik Chillar, ACTIV Capital Strategies, and we're a brand new, we're actually spin out of a larger private equity firm, but my partner and I took our commercial real estate debt investment business, have spun it out. We're in the process of completing a capital raise, so we're deep in the conversations with LPs and finding out how things have changed over the course of the last 12 to 24 months.
Great, thanks.
Jackie Kuiper, partner at Nelson Kuiper. We are an AI-focused securities law firm developing and using AI to help speed the turn of fund documents, fund launch, both public and private. On the private side, working on PPMs, using AI just to get a little bit of a head start, getting those PPMs then customized out into the market faster. And then on the public side, working same thing, using API integrations, grabbing info from Edgar, and speeding the turnaround on forms S1 when companies are going public.
Thank you, Jackie. Michael Richards, JTC Group. We are a global financial services firm where we provide both fund administration globally across 23 countries, along with private client services, so providing trustees for private client and high net worth individuals.
Okay, great. Well, we've got a pretty varied panel here today. We've got a legal perspective. We've got capital allocator in Nik. We've got fund administration in Michael. And perhaps I can start with you, Nik. I think it's fair to say over the last 18 to 24 months, it's been a relatively tough environment for the private capital sector. And just wanted to get your thoughts as somebody who's both raising capital and allocating capital in the commercial real estate sector. What your thoughts are in terms of the current market. Have we hit a bottom? What's your general perception in terms of what's happening in the market right now?
So it's definitely a market that's slowed down tremendously. There's a lot of people on the sidelines. I think a lot of the investors are having trouble deciding, are we at a bottom? Is this a good time to get into the market? We sit on two sides. We are constantly looking at investment opportunities. To be honest, even those have slowed down tremendously. And on the investment side, buyers and sellers of assets are still trying to discover value. So I don't think there's a clear understanding of where we are, whether we're at the bottom of the cycle. I have opinions on that. I tend to be lean a little bit more bearish. I think we are moving towards a normal interest rate environment, or normal for the world in which we live today and the state of debt. But I don't think that we're there yet. And I think that values have, at least from a theoretical or mathematical perspective, should have regressed by somewhere around 30, 35, even 40%. And what you see in the markets and in transactions is not even half that today. So I think that presents a problem. It slows things down. From our perspective, as someone trying to raise capital, it hasn't hurt us. We actually, it allows us to differentiate ourselves. You know, we can express a view, and because they're really varied views, the investors want to spend a lot more time understanding why we believe what we believe. They study kind of our backgrounds, our data, and so we think that's given us an ability as a small niche firm to separate ourselves from the pack. And I think that's been helpful for someone trying to start a first fund.
Yeah, and just, I mean, commercial real estate in particular seems to have, you know, I'll describe it kind of moving from the financial pages to the front pages. You know, I won't say the decimation, but certainly a very seismic shift when it comes to commercial real estate investment, the use of properties. I mean, we're here in the financial district. I'm sure many of these buildings operating at very low occupancy. We've seen reports of, you know, 40% occupancy in cities like San Francisco, so it is a very bearish picture. Now, on the flip side, and we do work with commercial real estate firms amongst our client base, some 650 odd funds across the platform, and I bet 40 to 50% of those are real estate. We're certainly seeing the emergence of distressed funds and those funds looking to take advantage of the down market. What are your thoughts on that, and maybe the sentiments from people you're talking to in the market?
Yeah, so I think anytime there's a shift in the market, everybody immediately wants to look for the distressed opportunities. My experience is that that takes a long time to show up in the marketplace as a real opportunity. I think that what's driving this particular downturn, if it will be a downturn, is interest rates, which they take a long time to really move through the system. And until you are forced to do something with an asset, as long as you can hold an asset, you don't have to realize value. And so I think those distress opportunities will come slowly. There certainly have been some, but not nearly enough to satisfy the capital that's sitting on the sidelines looking for it. And the prices at which those are transacting are not prices that we're comfortable with, at least. But I think there's a few things that will take place in 24. It'll start in the first quarter, but it'll really develop, I think, in the back half of 24, and that will be when banks start to have to realize that they've got assets, they've matured, something's got to happen to them. We have securitized markets, and as those assets come to a point where servicers, lenders have to push the borrowers to do something, that's when I think we'll start to see some of that distress. And whether it comes as an opportunity to invest rescue capital and help, you know, restructure a capital stack, whether it comes as discounted debt offerings, or whether it just comes as, you know, the train wreck option, the properties coming out of banks that are failing, that we have yet to see, and I'm not sure which direction it'll go. Yeah,
yeah. Jackie, appreciate that insight, Nick. Jackie, from your perspective, as a law firm specializing in the securities market, what are you seeing? I guess you're well, not to put words in your mouth, but I'm guessing you're probably at both the front and back end of that process in terms of new companies bringing new funds to market and maybe looking at the legal position of some of those firms at the back end. But what are you seeing?
Yeah, that's fair. For us, it really depends on the size of the client. The larger clients don't have the same type of struggles that the smaller ones do. Even the larger ones are moving at a slower pace as far as capital raise. Smaller ones almost came to a standstill. I've got a couple clients in mind that are early stage startups looking for capital. They're kind of right on the cusp of going out and having some luck. They're getting conversations, especially with VC, but they come back and it's kind of like a wait and see. The VCs are very much like, yeah, we're interested, but we're going to wait and see. And so I think there's a couple things tying in and causing that. And I think we'll dive into it a little more, but a lot of these groups are really concentrated in private alts and are kind of like, what do we do now, especially with public markets? Do we need to shift? Do we need to kind of reallocate or look at where we're investing? And I think there was a period of 6 months or more of just general uncertainty, and so everything just kind of stopped.
Yeah. Yeah, I mean, it is interesting. I think we'll pick up on that theme, but this kind of flight to quality, if you will, or the concentration of capital in some of the larger funds. As you say, it is certainly a challenging environment for those first-time funds or companies that are in the first couple or three funds. We're seeing that also. Michael, I'm interested in your perspective. So JTC provides services to thousands of funds across the world. I know your focus is particularly on the institutional side. Be interested in your thoughts, what you're seeing, and how you characterize the market right now.
Yeah, it's been interesting. As the institutional market slowed down, as Nick was talking about, this flight to retail. Everyone sees retail as the new frontier, and how do we get access to it? So as the market's been struggling with capital, they see that as, how do I do it? And they hear of the few groups that have had great success, and they're like, okay, let's go do that. But not realizing that they need technology like asset class to make that happen. Because at the end of the day, it's the broker dealer and the RIA who rules the roost, right? What technology are they using? You got to make sure you're tapping into that and not just trying to force them to use something. So when you can bring in something like asset class and firms like myself to be able to bring technology together, that's where we've been seeing clients make some strides in this market in a different way, right? Knowing that institutionals will come back. Private credit, that's probably sucking up most of the institutional dollars these days, as we've seen throughout the industry, right? Interest rates are high. Where can they get low? We've seen on the JTC side a little 50% increase in our EB5 business, which is paying to buy your green card, right, at the highest level. But it's cheap mezzanine debt. So you can get a mezzanine loan into a real estate deal at 9%. People are jumping all over that. So where that had a downturn, we've seen that turn around this year as well. So taking those difficulties in the institutional space, which are well known, and we're seeing those different areas now sort of provide a little bit of life to the smaller firms, right? The big guys will always get their allocation, but it's really the guys in this room, that middle to lower tier, that's where they're seeing great strides this year.
Yeah, I mean, it's interesting. Anybody who is keeping tabs on the trade press will have heard about the denominator effect in the institutional space. In other words, the way in which the markets have moved against the allocated capital from institutions means that in many cases institutions are kind of over-indexed on alts, right, on the broader private capital allocation in their portfolio. And so as a result, they've closed shop, I'm guessing. You'll be closer to it, obviously, because of your focus. That refocus, and we've seen some of the largest companies in the world, the BlackRocks of this world, et cetera, aggressively promote their retail offering. So it is interesting. We're going to touch on the theme of why the retail investor is rising a little bit later. But how are firms like JTC kind of adapting to that, Michael? I mean, that rise of the retail investor, and you're seeing demand from firms for that
It's interesting because right now the market's at a turning point here with retail. We are seeing a lot of talk around it, but it's having the distribution arm is the biggest challenge for everybody. We have a couple of clients that can get on the Morgan Stanley platform or JP Morgan and give them a $150 million allocation, and it's sold out in 24 hours. And that's what people see, the successes like that, and want to get into it. But really, at the end of the day, it's having that distribution and having that track record. So whether it's getting the operational due diligence done early, making sure you have everything, all your ducks in a row. These brokers and dealers are going to look for more, right? They need to be convinced. And that's a different play than the institutional investor that sort of knows already what they want to do. You're educating and you're really trying to persuade them to see differently in the alt space than what they're used to.
Yeah. And Jackie, I'm interested from your perspective with that, let's say, refocus on retail. Are you seeing more retail-focused funds come to you for those initial services? I mean, are you seeing that start to bubble up, or?
Yeah, and it goes to what does the retail investor need and expect? And so it's a lot of readjustment of expectations, and then looking internally at your processes, your tech, your software. And I think with the new rules, and we'll get into that too, a lot of these funds are not going to have the capacity or the ability to do a lot of the work to meet the new rules themselves. So it's going to be about finding the right service providers, outsourcing it, building those relationships at a pace that's going to work to facilitate fund, capital coming in.
Yeah, yeah. Nick, I'm interested from your perspective. Obviously, you're bearish right now. It sounds like in the midterm, where do you see the opportunities in the commercial real estate sector kind of emerging for private capital?
So I think I'm bearish, but I do think there's a lot of opportunities, and those opportunities develop, and they'll come in waves. Unlike the last downturn, with the global financial crisis, we had kind of all assets fall off a cliff at the same time. This time you're seeing this wave come through where on one day hotels are a desired asset class because you reprice daily and they're reacting to inflation and costs and able to maintain the most level of margin. The multifamily sector and the industrial sectors have been strong. In an industrial, you're going to start to see a little bit of slowing there. But it's still, there's income at least. Maybe values are changing, but there's income there. And then you go to office, as you were talking about, 40, 50% occupancy, and most of that is on a Wednesday. It's going to be hard to maintain those assets and figure out what you do with them. They're very expensive, costly assets to reposition. So, that's where your distress is today. And so I think that as this cycle progresses, you're going to see opportunities depending on what you want to do. If you want to invest in new loans that are on performing assets at kind of revised coupons, you're going to have great opportunity in the multifamily and industrial space. If you want to do some heavy lifting and some deep asset work, there's going to be office buildings, especially those Class B office buildings, that are in great locations for some sort of repositioning of the asset. They just probably won't work as office buildings for some time. And then I think there's going to be plenty of folks that just have a good asset and the wrong capital stack going into an environment where rates are moving up much faster than they expected. One of the things that you're going to start to see in the next couple of quarters is folks that have turnaround loans, bridge loans, floating rate loans, and haven't really felt the interest rate move because they've had for 2-3 years protective caps in place, and as those caps expire, they're going to have this massive reset in rates. And so you're going to see folks like that looking for some kind of rescue capital, equity investment opportunities. So I think there are so many places you can put capital, and it really depends on what your risk return profile looks like today.
Yeah, one of the things that's interesting, and actually Nick, a number of years ago, when I wasn't that familiar with the commercial real estate sector, was really my tutor in this, unbeknownst to him. But what's interesting for those who are unfamiliar with the commercial real estate sector is it's not like a residential mortgage, right? Where as long as you're meeting your payments, you get to keep your property. There are covenants, there are caps, there are things like debt service coverage ratios that if they start to get challenged, the banks can obviously step in, take your assets, sell it, right? As long as they get their coverage. And so that's really what you're talking about, right? Is that depending on what that capital stack looks like for that office building that you financed, you're going to start to come under pressure with interest rates rising and the impact of that, that servicing coming into play.
Yeah, and you're exactly right. There are a ton of covenants. It's more like a corporate loan, and it's not just about making the payment. It's about making sure the asset is being held up to some level of standard. Capital improvements are being made. There's money there for tenant improvements to attract new tenants as leases roll. And so there's a lot of reserves built into these loans that are also being used to they're almost being repurposed to keep the loan alive, to try and keep it working until there's some kind of a recovery in interest rates. And I think that's, in the last cycle, a lot of, so going to the denominator effect. In the last cycle, you had LPs react by liquidating assets quickly, getting out of funds, selling at discounted positions. And one of the things, at least from my perspective, I've seen is LPs have been less reluctant to do that. We've seen some institutional LPs that they've crossed a threshold and they've just gone back and reset that threshold so they can maintain it. They're not making new investments. And we've seen LPs that have said, we're fine being over for a little while, let's see where it goes. But they don't want to make that mistake of having a permanent impairment by taking the loss and selling out. And I think we tend to look at the last downturn whenever we're faced with a situation like this and assume things are going to work out that way. The problem is the last downturn was a financial crisis where capital just disappeared, and it reorganized and it came back into the markets. And it was very easy for governments around the world to participate in reorganizing that capital. This time around, it's interest rate driven. And interest rates are much harder, much more complex. As we've seen, the Fed first made the mistake of keeping rates low because they misinterpreted data. Now they're raising, and they're not sure. It's every day on CNBC, the first thing they talk about is, are we done? And nobody really knows, and I don't think the Fed themselves know. And so this cycle, where it goes, is it day to day? It's going to depend on kind of how things develop. And I think investors are going to react to that. And some of them will take advantage of opportunities that develop as they develop, and some of them will wait.
Yeah. It's interesting as we look across our base of clients, we get these signals, no pun intended, but some insights into what's happening in the commercial real estate market. And we're definitely seeing some bright spots, depending on the, let's say, the sub-asset class that they're focused on. Medical facilities, we're seeing a lot of interest in that and funds coming out to address that. Warehousing, curiously, retail seems to be making a comeback post-COVID. People are getting out there and engaging. I guess it's experiential retail. So there are some bright spots, but yeah, definitely some challenges, and it'll be interesting to see how that plays out. Just switching gears, Jackie, you mentioned a moment ago, or rather you made reference to the SEC and some of the new regulatory changes that have come out. So back on August 23rd, Chair Gensler, the chair of the SEC, announced a number of new rules around the private fund advisors, and it really focuses in on things like disclosure and investor communication and I guess increased transparency. Just interested from your perspective, from a legal perspective, I guess, and I appreciate that anything you say here, just to put it out there, is not legal advice or financial advice, but interested in your personal perspective on, is the SEC kind of overstepping its mark there? There were half a dozen or so industry bodies that came out against, these changes. And actually, it's an opportunity here, before I forget, to promote our podcast. Jackie and her partner were very gracious in joining me on the People of Private Capital podcast just in the last couple of weeks to talk on this very subject. So we'll get to touch on it now, but if you want a deeper dive, Jackie and Andrew joined us on the podcast. Wherever you get your podcast, the People of Private Capital, please go and check that out. But on that subject, Jackie, what are your thoughts on the SEC's moves towards this? Is it incredibly onerous? Is it overstepping the mark?
So many thoughts. Thank you for the disclosure. Not legal advice. Just sitting up here ruminating on SEC rules, which is riveting for most people. It depends who you ask, I think, right? First of all, the context around the new rules is that it applies to private funds and the advisors to those private funds. So that's the context we're in. And a lot of the rules are about, auditing, making sure that you're disclosing your performance in a certain way, disclosing performance more often. So when I say it depends who you ask, from an investor standpoint, that could be great, getting more disclosures. VCs that are hesitant to place capital because they're getting a once-a-year valuation, now they might have an opportunity to get valuations far more often, and they may have increased comfort around those types of assets and those types of funds. So it could generate interest there. It could also benefit retail investors because they're getting access to more information, more is disclosed to them. However, what's the cost of that, right? Again, these funds aren't necessarily going to have the ability to come into full compliance quickly, if at all, without going outside of themselves and hiring service providers, hiring fund accountants, hiring external auditors. And so what type of cost does that place on the fund? I don't think we'll know yet. So again, long-winded way of saying, depends who you ask.
Yeah. Yeah, I mean, I think the disclosures and the increased transparency, as you say, it's a positive, right? Kind of writ large, we have, as investors, greater transparency around how the fund is performing. We get more frequent updates. But as a provider, or rather a general partner or a firm servicing that, it is more onerous, right? It demands that you communicate more often with investors, that you increase that transparency, that you're subject to audit. One of the things, Michael, that struck me when I read the rules to begin with was one rule in particular which focuses on transparency and communication with investors around preferential treatment. And we all know that money talks. And so if you are an institutional investor in a fund, it's quite reasonable if you're putting, let's say, 20, 30 million into a $100 million fund, that you may be subject to preferential treatment, right? That you may get better management rate or some other preferential terms. I'm interested in your perspective with your focus on institutional money around the impact of those rules and whether that's going to disadvantage institutional investors. What are your thoughts?
Yeah, it really is going to disadvantage the top 25, really, when you think about it, right? The big ones. Mm-hmm. But at the end of the day, it's probably good for the market. I don't think, based on talking to people in the industry, these transparency rules are probably going to be looked at again. You mentioned the lawsuits that are out there. Talking to our intermediaries in the industry, that really seems to be the groundswell right now of feeling anyways, that these transparency rules, in particular, the disclosures there, are the ones that probably have the most legs to have maybe a reversal being done here. But at the end of the day, the biggest thing is, if you're in this space today and you're a GP out there, start working on this now. You're already behind. Right? If you haven't thought about this, you haven't started to plan, you're too late. We're coming up on the 2 months now soon, right? In October will be the 2 months since they released at the register. That kicks off the 12-month window. You need to be actively talking about this internally, because we as service providers are doing that. And if we're going to struggle with the 1-year lead time, and the benefit for us at JTC, we actually have a GP in-house. And so we run about $22 billion in funds. So we're a large provider. We're going to be in the 12 months. So we have to build this internally anyways. And we feel like the pressure's on us, right? So get started on it now. That's the biggest advice I could have for anybody in this room. Even if you're not registered today and not falling under the 12 months, you got to be there, because when we look at the commercial real estate industry, all those fees at all different levels of the structure, if you're a GP, you're going to have to disclose all that. So you have to look through every level of your structure, aggregate any type of income that's going to any entity within your umbrella. And that's going to be the strongest push to make sure that hits the market, because they want people to know where the fees are going. But also, it's where the data is most disparate. Right? And so that's the thing you should be worrying about if you're in those spaces.
Yeah. Yeah, it is interesting. I mean, for those of you who are clients, we've got you covered, which is great. That communication that you need to put out to your investors, the communication platform that we provide enables you to do that. For those prospective customers, please come talk to us. We'd love to talk to you about how we can help you with that. Just kind of sticking with the institutional side for one moment, Michael, I'd like to kind of step inside the head of institutional investors right now. We talked kind of briefly there about their hesitancy around the alternatives marketplace, et cetera. How would you characterize the kind of conversations you're having with institutional investors right now? I mean, is it complete pause, or is it cautious optimism of a return, or what's the insights that you're getting there?
Yeah, it's targeted investing, I would call it, right? So yes, we're seeing a pause in the overall flow, but where there are deals, where there are things they're confident in, they're willing to jump in, right? So it's really picking and choosing today versus before. It was a little bit more, there was more capital there, they had to deploy it, there was a little bit more, I don't want to say taking chances, but they're really focusing in and making sure what they're doing today is meeting their needs, right? Versus just filling an alts bucket, which we saw for many years, right? Wanted to get great exposure, to get away from the public markets, returns weren't there. And so now with returns coming back, at least in the past year, that's giving a little bit of added pressure to just the downturn in the market in general. So how much is it that they want to pause on alts versus how much is it they don't want to miss out on the returns in the public markets as well?
Yeah. And Nick, just finally on this topic, someone who's raising capital and capital allocator, in your conversations with institutional investors, what's been your experience? You're focusing on commercial real estate.
I think that we're seeing, because we specifically invest in debt products that have current income, and they come with a lot of current reporting also. So I think there's a shift. I think you alluded to it, Mike. There's a shift as rates have gone up. Credit products are much more attractive. They're somewhat defensive. We're investing in loans that are at 65% of current values, as opposed to buying an asset at 100 cents on the dollar and owning all the equity. So if there's a downturn, the equity absorbs a lot of that before the credit gets hit. And in the meantime, we just keep clipping coupons. So I think the institutional investors are certainly moving more towards credit. It's much more attractive. Rates have gone up pretty dramatically. The thing we compete with, however, is their alternatives have gone up too. The publics are also yielding. Bonds now have a coupon on them, which they haven't for almost 20 years. So that's made it a little bit more competitive, and they are having to make decisions. Do I give up liquidity to go into an alt? How much more am I getting there? And that's what we spend our time educating them on.
Yeah. Well, if we kind of flip gears then on the institutional side down to the retailer, we mentioned the retail investor and the rise of the retail investor a little bit earlier in the conversation. How important, perhaps Jackie, from your perspective, is it, I know you made reference to the fact that companies need to prepare themselves for the retail investor engagement, but how important is it, do you think, for firms today to really focus on that? It seems to be a bright spot amongst RIAs, still some family office money coming in, and actually I think the RIA and family office markets are on the rise. There's consolidation that's happening in that space. Curious to see what you're seeing there when we think about kind of high net worth individual money coming in, family office money coming in.
Yeah, I think it's very high priority. I think there's a huge recognition that that's a big untapped market, huge potential for growth. So to Michael's point, if you're not thinking about it, be thinking about it. This is going to be a high priority, and from a legal standpoint, from the SEC's exam standpoint, if you're a fund or an advisor in that space, you've got to work quickly to have everything really tight. The SEC brought a suit against 9 advisors, and the lawsuit wasn't so much a problem about what the disclosures said. The problem was that they didn't have their books and records and policies and procedures in place to prevent a violation of the rules. So right away, the SEC is like, if you're going to head into this space, head into this space, but do it right, have it tight, have all your books and records, have policies and procedures in place off the bat to get everything in a row once you're going to launch in. And I think this goes back to understanding retail investor expectations, as opposed to if you're BlackRock working with institutional investors, that institutional investor has a far different expectation set as far as illiquidity, how long their money's going to be tied up. If you're working with retail, you've kind of got to reassess your entire fund, because those retail investors are going to have far different expectations than institutional money.
Yeah. Yeah, and on that topic, Michael, if we step inside of JTC without any trade secrets here, are you seeing that kind of come through in, let's say, the volume of subscriptions or the source of subscriptions from RIAs, financial advisory firms, et cetera, versus institutional?
Yes, and again, I go back to my earlier comments, right? It's if you have the distribution, we're seeing in those tickets, absolutely. But that's where, when we talk about the industry and the rise of the retail investor, what are the things that you need to be worrying about? Well, one of the things alts never really worried about was making sure they could publish their NAV to Fidelity or TD or Schwab or whatever. And so making sure that you have that in there, because if the RIA can't charge the assets because they're not receiving it through their brokerage statement, that's going to be the killer. So it's not necessarily the individual investor that we're seeing the problems with our clients, but it's really the RIA level, the BD level, making sure that they have the tools, to sell, that they understand their product and they can confident, but also knowing that they're going to get the same data back, right? Will that show up in my Fidelity statement for XYZ client? Can I bill them at the end of the month, right? That's been the biggest push that we've seen across our clients, is making sure that sort of new investor servicing is not necessarily the end investor, but really it's that broker dealer, because that's what's going to propel them to either invest more if the fund is still open or come into the next vintage as we move on.
Yeah, yeah. What about you, Nick? Just in terms of your market engagement, are you seeing more on the retail end?
We haven't engaged in the retail side of the market yet. That is something that's on our agenda. We're exploring kind of how we get that distribution, but we're not at that level yet.
Yeah, yeah. Okay, great. Well, I know we're a little bit over time. I think we've touched on a couple of the three key themes here. What I see us describing here is that next generation investor, right? Those retail investors that we're looking to engage with, that firms like yours are looking to engage with. That concept of engaging with the retail end of the market is new for many of your firms. We can certainly help you with that. But I think the concept of becoming a neo firm, right? That new normal and addressing the requirements of those investors is part of the challenge. How do you, as Jackie mentioned, deliver that capability at scale? We can certainly help you with that. So with that, I'd like to thank our panelists today. Thanks very much for your time, Nick, Jackie, Michael. And we'll break for coffee now, and we'll come back here at 11:10, get back on track. Thanks very much.